All right, let's take a look at SoFi Technologies Inc., ticker SoFi. The U.S. market is currently closed. SoFi finished yesterday's session, October 21, 2025, at $28.75, up just slightly on the day by 0.24%. In after-hours trading, it has slipped a bit, trading around $28.50. Now, the first thing that jumps out at this $28.75 price is the massive disconnect. This stock is up roughly 163% in the last 6 months and around 72% year-to-date. It's absolutely ripped, trading very close to its 52-week high of $30.30. The expectation from this kind of chart action is that Wall Street must be universally bullish, with analysts tripping over themselves to upgrade it. But the reality is that the consensus rating is a lukewarm hold. In fact, just about 8 days ago, Goldman Sachs raised its price target, but only to $24, a level the stock has already left in the dust. This isn't a story of universal acclaim. It's a story of a stock that is aggressively defying muted expectations. This suggests that the retail investor, perhaps those using the SoFi Invest platform itself or the Robinhood app, is seeing something that the institutional models are failing to capture. The common belief, the one that gets passed around on investing sites, is that SoFi is the super app. It's the one-stop shop for high-earning millennials, a place to bank, get a loan, and handle their online investment needs. The expectation is that this ecosystem creates a moat where members come for one product and stay for 5. But the reality of the business is far more complex and, frankly, more interesting. The super app isn't the business. It's the marketing funnel. The real engine or engines are two very different operations: a high-growth cyclical lending arm and a high-margin scalable B2B technology platform called Galileo. The $28.75 price point reflects a market that is pricing this company for perfection, betting that both of these engines can fire on all cylinders simultaneously, even as massive macroeconomic headwinds build. Let's break down the recent action. This stock's movement is not like the steady march of Apple stock. It's a volatile, high beta name, much more akin to Tesla stock or even Nvidia stock in its sensitivity to news and narrative. The primary driver for SoFi stock over the last year has not been its latest credit card offer. It has been the 10-year Treasury yield. SoFi is, at its core, a bank. It makes a significant portion of its income from lending, specifically personal loans, student loans, and home loans. When interest rates are high, its cost of capital goes up and demand for its refinancing products dries up. The massive run-up we've seen is in large part a bet that the Federal Reserve is done hiking and will be forced to cut rates in 2026. This is a macro bet. If you are doing self-investing and you buy SoFi here, you are not just betting on member growth, you are betting that you know the future path of inflation and monetary policy. The institutional desks, perhaps those using the sophisticated platforms at Interactive Brokers, are watching the credit quality like hawks. In the last earnings report, delinquencies in the personal loan portfolio ticked up, just slightly, but it was enough to make people nervous. This is the central risk. The expectation is that SoFi members are high-quality, high-income borrowers who won't default. The reality is that a recession, even a mild one, will test that thesis. We saw personal loan originations jump 66% in the last reported quarter, and home loan originations were up 92%. That's fantastic growth, but it's growth that is coming right before a potential economic slowdown. This is the tension. This is why many investors who are seeking investment help are often steered toward more diversified options, like Schwab Intelligent Portfolios or a suite of Fidelity ETFs. An intelligent portfolio won't give you the 163% 6-month return that SoFi just did, but it also won't carry the risk of a 50% drawdown if credit markets freeze. Fidelity Investments, with its long history, offers a range of Fidelity mutual funds that provide provide broad exposure without this kind of single stock risk. When you open an individual brokerage account, you have to decide what kind of investor you are. Are you the high-risk, high-reward trader using Interactive Brokers trading tools, or are you the long-term accumulator building positions through the Fidelity platform? SoFi Invest is trying to be the platform for that new investor. It offers SoFi stocks, SoFi ETFs, and even a SoFi robo-advisor. It's competing directly with Robinhood, which has a huge user base through its simple Robinhood app and features like Robinhood fractional shares and Robinhood crypto. But SoFi has a trump card Robinhood doesn't, the bank charter. By having its own bank, SoFi can attract massive, low-cost deposits through its high-yield checking and savings accounts. As of the last report, deposits are exploding. This is the critical synergy. They use the high-yield account to bring in members, then cross-sell them a SoFi active investing account or a personal loan. The deposits they gather provide a cheap source of funding for the loans they originate. This is the super app model working. The upcoming earnings call, scheduled for October 28th, is the next major test. The consensus is for 0.08 in EPS, but nobody will care about the EPS. All eyes will be on guidance. Will they maintain the blistering 34% year-over-year member growth, which just hit 11.7 million? And more importantly, what will they say about credit? Any hint of caution on delinquencies could send this stock tumbling from its highs. Now let's briefly touch on those business segments. First, there's lending. As discussed, this is the cash cow. It's what makes the company profitable. This segment is highly cyclical and depends on the macro environment. Second, financial services. This is the super app segment. SoFi Invest, SoFi Money, the credit card. This is still largely a cost center, but it's the member acquisition funnel. Its growth is what feeds the whole machine. It's competing with everyone from the Fidelity mobile app to the Robinhood cash management feature. It's a brutal, low-margin fight for customer acquisition. Third, and this is the part that many investors miss, is the technology platform. That's Galileo. SoFi acquired this company, and it provides the back-end plumbing for other fintechs and banks. When another company wants to create a debit card or a digital wallet, they can use Galileo's APIs. This is a B2B high-margin software-as-a-service business that has nothing to do with personal loan defaults. Galileo just joined the AWS Partner Network and is expanding rapidly with 160 million global accounts on its platform. The company is investing heavily here, adding 225 jobs in the banking hub of Charlotte, North Carolina, and 410 new jobs in Utah. This is the hidden asset. The expectation is that SoFi is a consumer-facing bank. The reality is that it's also a critical piece of B2B infrastructure. Looking forward, the future for SoFi stock from $28.75 is a true fork in the road, and it all comes back to that tension. The bull case is simple. The Fed cuts rates. This provides a massive tailwind for the lending segment, expanding net interest margins. At the same time, the market finally recognizes Galileo's value and assigns a high multiple tech valuation to that part of the business. The combination of a booming bank and a re-rated tech segment sends the stock soaring past its $30.30 high. In this scenario, the super app strategy works perfectly. Deposit growth continues, and SoFi solidifies its position. The bear case is just as simple. Inflation remains sticky, and rates stay high. This compresses lending margins. Worse, a hard landing recession finally hits, and those personal loan defaults spike. The stock, currently priced for perfection, would have its valuation collapse. The narrative would shift from high-growth tech to risky subprime lender. In this world, investors would flee to the perceived safety of Fidelity Wealth Management or Interactive Brokers, platforms seen as more stable. This brings me to the central question for anyone holding or watching this stock. What is SoFi? Is it a tech company that happens to own a bank, or is it a bank that happens to own a tech platform? Your answer to that question determines whether $28.75 is a bargain or a warning sign. I want to hear from you. Comment below with what you think is the real driver for this company. Is it the lending business or is it the Galileo tech platform? Let me know which segment you believe justifies this valuation. So, to summarize, the story of SoFi at $28.75 is a perfect example of expectation versus reality. The expectation, fueled by a 163% run-up, is of an unstoppable super app firing on all cylinders. The reality is a far more fragile and complex picture. It's a high-growth lending business, highly sensitive to interest rates and credit risk, stapled to a genuinely promising B2B tech platform. The market is currently valuing both as if they will grow to the sky without a problem. With earnings just days away, investors are holding their breath to see if that high-flying expectation can